Okay, another instrument for investments is an equity security, probably one of the more common ones you've heard of before. Common stock is the first type of equity security we're going to talk about. Stock represents ownership, shares in a publicly held corporation. Shareholders usually have voting rights when they are common stockholders. They also can receive dividends, but they're not obligated. The corporation is not obligated to pay dividends in any way. We'll talk about how preferred stock usually, or oftentimes you are obligated. They also have residual claim. This means if the company goes under or goes bankrupt or anything like that, once liquidation has occurred, there's a level and step to bankruptcy where we have different individuals that are paid first. I'm not going to quote all that to you, but you have lenders and secured, especially secured and collateralized lenders and things like that on top of the list. And then once we get down to where we're liquidating kind of the remainder, shareholders, common stock shareholders are on that list to have residual claim to assets or money that comes from those assets when liquidation is occurring in an organization. They also have limited liability, meaning just because you own a share of stock in a company does not mean that you're on the hook for any legal claims against that company. So example right now, Epic Games and Apple are going through a legal battle with purchasing things through the Fortnite game currently. If you own a share of Apple, they're not going to come to you and ask you to pay any of it. Let's say Epic wins. If you own a share of Apple, they're not going to come and ask you to pay for that. You don't have any liability there. The corporation itself has a liability. Your liability in a corporation as a stockholder is limited to your investment. So the most that you can lose is whatever your stock value is. The equity that you have in that company is the most that you can lose. So if you have $10,000 worth of stock, the company goes away, and they go away because they were sued or something happened and they had to liquidate and basically pay off a whole bunch of things. You could get $0 out of that, even though you do have residual claim. If the claimants, the list of claimants is higher than yours, so higher priority, legally speaking, than yours, then the most you can lose is what your stock ownership value is. Then there's preferred stock. Preferred stock has priority over common stock. A lot of times they have fixed dividends, more of a fixed income type scenario here, where they give a certain percentage of dividends that they promise every year. Now, what's interesting about this is that a lot of preferred stock is non-voting, and a lot of times there's a difference between what we call cumulative and non-cumulative preferred stock. Cumulative preferred stock means that the preferred stock itself states a percentage of dividend that they're going to give you annually, and they have to pay that to you. Now, that being said, they don't have to pay that to you in the year necessarily that you own the preferred stock. So let's say you owned the stock last year, 2019. The company decided not to pay dividends, but they were supposed to pay you a 5% dividend on your stock. That's fine. And then 2020 comes around, and then they decide to pay dividends. They pay you as a preferred shareholder first, and not only pay you first, they pay the oldest ones first. So they would pay 2019s if that's the last one that they hadn't paid. They pay you for your 2019 preferred stock, and then if you were owed for this year, they would pay that, the 2020, and then if there's anything left over, then you would see the common shareholders get paid. So it accumulates, cumulative preferred stock accumulates over time with those dividends, but the corporation still has the right to declare that dividend, but they do have to pay the older dividends if that is, if there are older dividends, or what we call dividends in arrears for the preferred stock. Usually non-voting, and the tax treatment, they usually have an exclusion of 70% of the dividends earned. Okay, capital gains and dividend yields. If you buy a share of stock for $50, and usually we're talking about the secondary market here, and hold it for a year and collect a $1 dividend, and then you sell the stock for $54, what is the dividend yield? Now, they made this simple because it's a full year, so there's no adjustment. We basically we're assuming, let's say from January 1st to December 31st, you bought on January 1st and sold on December 31st. It makes this a little bit easier because if you're doing like an annual, if you're annuitizing this, or doing annual yield, if you hold it for multiple years, the calculation gets more complicated. But if it's just a simple, you hold it for a year, we can find our total return by taking our selling price minus our buying price plus our dividend divided by our buying price. I did that one in Excel here too. So if we purchased for $50, we sold for $54, and our dividends were $1, then I just did exactly what the calculation said. Selling price minus purchase price plus dividends divided by the buying price. So the overall return is 10%. The dividend yield is figured just based on the purchase price divided by the dividends, and the capital gains yield is the difference in the buying and selling price, so 54 minus 50 divided by the purchase price, for a yield of 8. And as you can see, if you add your dividend yield and your capital gains yield together, you should see your total return. And you can see their calculations here, just like I did. Okay, this is just an example of listings on the New York Stock Exchange, what they look like and what a listing looks like, so we understand all the information that comes in a listing. The symbol, which is their also called their ticker symbol, which is how you can look them up if you want to look them up. Close means what they closed at for the prior day, what their net change was, generally for the day on this case, May 5th, 2017. Volume, this is how much the stock is being traded. Okay, so volume of trade, you can see that varies a lot. We have everything from 200,000 shares to 19 million shares. 52-week high and low kind of explains itself, what the stock has done in 52 weeks, what the highest point was and what the lowest point was. So like you can see, GameStop is pretty close to its low point. It's not all the way there, but it closed at 23, and 20.1 is its low point, and its high point was 32, so it's much closer to its low point 52-week than high point. And then this is the dividend yield. PE is price to earnings ratio. We'll talk about that in a later chapter. And then year-to-date change is how much it's gone up or down for the year currently. Okay, bonds, stocks, and bond indexes. We use this to track averages. And actually, I think I'm going to go ahead. I'm trying to make my videos a little shorter for this class. I think I'm going to go ahead and stop there. I'll continue with this video, or continue with stocks and bonds indexes on the next video.